Ashburton's credit philosophy is that returns of fixed income portfolios can be enhanced through adding credit exposure to those portfolios in a responsible manner. That is achieved through a combination of a macro top-down process where certain themes and sectors of preference are identified, and that is combined with a detailed due diligence process to ensure that appropriate exposures are added to the portfolios. The benefits of employing a strategy like this is that broader themes in the market are identified through the macro top-down process, and this helps to identify sectors that should either be where exposure should either be gained to or where exposure should be avoided. This then is combined with a detailed bottom-up due diligence process to ensure that the correct underlying instruments are selected and entered into the credit portfolios. The strategy is implemented by making sure that you have sufficient exposure to a broad enough universe of credit instruments. If you look at the South African market, the listed credit markets is quite a concentrated universe of investments, and often if you have cash available in your portfolios, you become a force buyer of instruments as and when they come to the market. By gaining exposure to the unlisted loan market as well, you are augmenting your universe, and you are able to deploy cash when the right opportunities come along, and you don't have to sit on cash in your portfolios, which may drag returns. In such a way, you can take those macro themes that are identified, let's call it into sectors that you either increase your exposure to or sectors that you avoid, and you can pass up on those opportunities as and when they come. The key to accessing the unlisted loan market is ultimately through relationships with the large South African banks. And at Ashburton, we have a beneficial relationship with Rand Merchant Bank, which is one of the leading investment banking franchises in South Africa. But we also maintain regular contact with the other large South African banks to ensure that we see a steady flow of opportunities for our investors. Due diligence is a broad-ranging assessment of the risk you're potentially exposing your customer through by investing in credit. It looks at the financial performance of the entity. It also looks at the strength of the management, as well as the industry in which the company operates. Ultimately, it's this process that will determine whether you are comfortable that the investor will be able to recoup its capital that you have lent out to the corporate through them being able to repay their debt. Governance is an important part of the due diligence process. This includes an assessment of both the management team and the board of directors. In terms of the management team, you want to make sure that the management team is well regarded and they've achieved a number of successes in the market to date. The board of directors needs to be assessed in terms of having a strong contingent of independent directors, which is able to hold the management team to account, both at the board level, but also at the underlying committees, such as the Audit and Risk Committee. Ultimately, the nature of the instrument determines whether it's an appropriate risk for the investor to take. Important considerations for the underlying instrument is its seniority in the capital structure and also whether there's any security attached to the instrument. Both of these factors will play a large role in terms of a workout and the ultimate recovery of capital in the event of a default and lenders have to restructure the business.